Yeah, I think a lot of times challenges that come into the business can block you from growth because you kind of get caught up in like the I call it the kind of oh crap mode where you kind of put the tail between your legs and try to, hunker down and have fear and worry on that particular thing. And one of the things that I've always tried to do is just to make sure that even when adversity comes about, you can't stop focusing on growing the company as well as maintaining what you already have built up to that point.
Ladies and gentlemen, this is episode 73 of Keeping It Real Estate. Our guest today is Dan Handford, a multi-family real estate syndicator and founder of PassiveInvesting.com. Dan has helped countless investors achieve their financial goals through strategic real estate investments, and he's here today to share his expertise and insights with us. So let's dive in. Dan, if you want to start off by giving some background on yourself, that'd be great.
Sure. Yeah, that sounds great. I appreciate it, Dan. And we'll always call this the double Dan episode since there's two Dans on this episode now.
Yeah.
So to kind of give you a little bit of background about myself, I'm one of the managing partners, like you said, of PassiveInvesting.com, and we primarily acquire large apartment complexes. So right now we have roughly about 1.4 billion in assets in our portfolio, and about 1.1 billion of that is actually in multifamily. The other amount of the portfolio is a mixture of self-storage assets, hotels, express car washes, as well as our debt fund that we have as well. But the majority of our holdings is in the multifamily space. And prior to being a multifamily kind of syndicator, if you will, I was actually a chiropractor by trade. So I have a degree in chiropractic, and back in 2018 decided to kind of move away from doing that full time. And I still actually have 4 clinics, and we do a unique thing in our clinics where we don't do any chiropractic services. We actually do a lot of medical procedures. We do a lot of PRP, prolotherapy, stem cell treatments for orthopedic conditions. We do a lot of non-surgical orthopedics and sports medicine. And so those clinics generated a lot of cash flow for us, and they're 100% debt free. My wife and I grew those clinics from 1 location to 4 locations, and that created a problem, and that was a tax problem, right? So when you have a business that doesn't have a lot of debt and it cash flows nicely, it causes you to have to write really large checks to the government. And so going into the real estate side of things really helped us to be able to reduce that taxable liability. Now our income has increased, and we pay even lower amount in taxes each year, which is the primary reason for kind of going into that space. And started syndicating some of our first deals in 2018, and even before doing that, started to invest passively as a passive investor and into a couple of different projects, and then co-GP'd with a few groups, kind of get our feet wet, kind of build our track record and our experience. And then in the latter part of 2018, acquired our very first multifamily property, started acquiring assets then, and ended up raising about $4 million from our investors in 2018. 2019, we ended up raising 32 million. 2020, right in the middle of the pandemic, ended up raising 61 million from our investors to acquire some assets. And then in 2021, we raised 196 million. And then last year, 2022, ended up raising 294 million from our investors. So right now we're sitting at about 580 million that we have raised from our investors since 2018, and acquired about 1.8 billion in assets with that. And today, since we've sold a few assets, we're sitting at about 1.4 billion in assets under management.
Well, that's awesome. You guys have had amazing growth very quickly. So when you guys are buying multifamily, you said about $1 billion of assets under management. Is that right?
That's correct.
Yeah. What type of criteria do you guys have in multifamily when you're looking to say, yeah, this deal's a deal or no deal? And what markets are you guys focused in?
Yeah, so we're primarily in the Southeast. We do have some assets in the Texas markets as well. We're also looking into some other high growth markets like the Arizona markets, as well as even in the Boise, Idaho area. But we're primarily based here in the Southeast. So I actually live and work here in Columbia, South Carolina. And I would say the majority of our assets are in the Carolinas, inside of Georgia, Tennessee, down into Florida. So that's where the majority of our holdings are. And so when we first got started with our group, we actually went after kind of a lower class, like class C and lower class B or lower in B asset, like a B minus, if you will, and do the traditional kind of value add play, go in there, renovate the asset, spend a lot of money, doing interior upfits as well as spending some money on the exterior and increasing the amenities. And one of the things that we found is that during that kind of 2000 and into 2019 and into 2020, one of the things that we noticed is that there was a huge, there was a smaller gap actually happening between these kind of higher end kind of class A and B plus assets and the class C assets. And I actually had a good friend of mine that was buying an asset in a it was a primary market, and they were buying a class C asset at a 3.4 cap. And we were buying an asset in that very same market for a 4.5 cap at that time. And one of the things that I decided is that, at that time we needed to pivot and change our focus to the assets that are going to be more kind of core plus assets that would allow us to be able to maintain some consistency in cash flows. And even with some potential, kind of downturn happening, because it was right for a downturn, we needed to pivot and kind of change that strategic focus. And so we changed and actually focused primarily in the beginning of 2020 to acquiring what we would call suburban class A assets, not your kind of downtown urban infill kind of high rises, but more of your suburban class A's and your B plus assets. And it has proven to be a very good decision for us. We acquired quite a bit of those. I would say our average age of our assets is probably roughly around 10 years. And so we have a good number of quality assets that have a lot less age on them, a lot less, concern for, CapEx, random CapEx items coming up. And so it's been good. And even right now, being in 2023, it's been good for us to kind of know that we have some good quality assets there. We're not concerned about huge CapEx items that are going to be coming up and heavy lifts on the renovations.
Gotcha. Do you guys, for the properties you acquired between 2020 and 2022, do you guys have any bridge debt in place with variable rates? And if so, how are you guys handling those deals?
We do. I would say about 50% of our portfolio right now is bridge debt, which has some form of floating rate on there. One of the things that we did as a strategic decision in the very beginning on all of our multifamily assets, we have a rate cap in place. So we're at the max on the rate, the increase that it can get to at this point in time. And the nice thing is that one of the things that we always do in our assets is we always overcapitalize a deal. So we usually like to have about 6 months of operating reserves, where if the property went down to 0% occupancy, we can continue to maintain that asset, even if there was, we're still paying the same amount of expenses on it, right? And the income pretty much goes to nothing. And so, a lot of other operators that I've talked to, they don't like doing that because it does take more time and energy to raise that extra money to be able to have that as reserves. But for us, it allows us to be able to sleep well at night. I call it the SWAN principle, right? Sleep well at night. And so that's one of the things I think has really helped us even right now, is that yes, on some of these assets, we are dipping into those reserves, but it has really helped us as we have been able to not be forced to sell an asset or, be in a position where we have to do capital calls or anything like that. So we've never had to do a capital call. And right now we don't see any capital calls in our future.
Gotcha. And when you guys are buying these deals, you're putting a little extra cash in, you've got this bridge debt. What kind of terms do you guys have generally when you do it? Do you have a rate cap that's 2 years, 3 years? And what kind of spread? Maybe just a little bit on that, and then we can move to the next question.
Yeah, I mean, I think it just depends on the deal, right? So we've had some that are, a year and a half, 2 years. We've had some that are, up to 3 years. And of course, over the last probably 6 to 9 months, we've seen those rate caps significantly increase. And even I've seen some people, when they sell an asset, they sell the rate cap as well and even capitalize on that because of how expensive they are right now. But the terms are really dependent upon the loan itself and kind of where we are in the market cycle at that point in time. So they do range from, 1.5 to 3. And then as far as the percentage, it's usually around a 2% cap rate.
Okay, gotcha.
Rate cap, if you will.
Yep. Gotcha. Okay, good. So when you guys were buying deals originally, I just want to get a little more understanding for, let's just say there's some folks here that would love to start to do more of what you guys are doing. You came in, You started and you said, was it 2018 you bought your first deals?
Correct.
Correct. So yeah, and you're at 20 in 2023, you guys have $1.8 billion in assets under management, or $1.4 billion after some sales, somewhere in there.
Correct. 1.4 billion right now.
$1.4 billion. I guess, how did you guys get to scaling at that speed? And then how do you source your capital and equity? Because you guys have raised insane amounts of money.
Yeah. Well, I think there's not really one easy button answer to that. So I think everybody actually tries to ask that question of like, hey, what is the one thing you guys do that brings in the most, success for you? And there's never been just one thing. It's been a multitude of things. And even from a marketing perspective, to be able to attract new investors in, there's not been just one thing that we've done. I think, one of the things that we always practice is what I call a multimodal approach to marketing. So there's multiple things that we do, whether it be our podcast, whether it be our LinkedIn channel, our YouTube, our weekly webinars, our multifamily investor nation group that we put on. That's we have a live event once a year. We've also done some virtual events. All of those things combined, as well as our in-person events. And I get invited to speak on stages quite often now as well. Matter of fact, later this week, I'm flying out to Salt Lake City to speak on a conference stage this weekend. So there's a lot of those things that kind of build on top of each other. And that I think are 1 month, the podcast might bring in a lot of leads, and next month it might be, the website or the LinkedIn or the YouTube or the webinars, things like that. But there's never really been just one thing. But I will say, when we first got started, we had, anywhere between 5 to 10, maybe 15 new leads coming in every month. And, right now, if I pull up on our website, just looking at right now, it says since February 5th, 2023, we had 417 new investor leads come to our website. So usually it's between about 300 to 500 new leads every rolling 30 days that come in off the website, of people who go to the website, raise their hand saying, yes, I'm an investor, I'm an accredited investor, and I want to invest with you.
Gotcha. So you founded Multifamily Investor Nation that now has over 40,000 members. Is that correct?
That's correct.
And what is Multifamily Investor Nation?
Yeah. So, one of the things in the very beginning when we started that we did not want to do is we didn't want to get into the coaching and consulting space. We felt like that is going to be something that would slow us down and reduce our velocity of acquisitions, which is really what we were designed to do, is to increase that velocity of acquisitions and to be able to provide these investment opportunities for ourselves to grow our wealth as well as our investors' wealth at the same time. And so the Multifamily Investor Nation was created to be an authority platform to be able to teach other people what we do, because we do realize there's a lot of people that go out there and try to do some research online and try to figure out, if they want to do this actively. And once in our weekly webinars and our education, our training, we don't hold anything back. We tell everybody exactly what we're doing step by step. Every single week, we have a free weekly webinar, but we don't sell any coaching programs or anything like that. So there is no barrier that's built up from the people from our audience. And so our goal is to teach them as much as we can, because we know there's a lot of people that do that research and they go, you know what, this is a lot of work. Here's my money, you do it for me, right? And so we do get a lot of passive investors from that kind of angle. And one question that I didn't answer that you asked earlier, Dan, was around where we get our capital, where we source our equity. And 100% of it has been in private accredited investors. So we have just over 2,000 accredited investors that have invested with us since 2018. Average investment size is $127,000, and we have not accepted any institutional money at all. So all of this is from private individual accredited investors.
Awesome. I love it. Why did you want to start, this group, the Multifamily Investor Nation, and what was the motive behind it? Was it just to help educate folks? Was that really kind of where you were at?
Yeah, I mean, the whole goal is to be able to, create an opportunity to fill our funnel with new investor leads, right? And so that definitely helped with that. It also helped me be able to get on stages, because now that I had this group and this audience, I was able to reach out to some of these people who are putting on events and say, hey, what can I do to add value to you? I never asked to speak on their stages, but I said, hey, what can I do to add value to you, to your event? Can I help promote it? And they'd say, oh yeah, you can help promote it. Here's the link, we'll track your referrals and give you a kickback. And I was like, I don't want any kickback. kickbacks. I don't want any referrals. Just let me promote it for you. I just want to help out and then promote for you. And over time, they just started inviting me to be able to come to the event as an attendee, and then also invited me on future events to be able to come and speak to their group and their audience. And that was the main reason for the Multifamily Investor Nation, is to be able to provide value to the community. And if you know anything about providing value to other people, that rule of reciprocity, that value is going to come back to you as well in the future.
Gotcha. I love it. I love that I'm just here to add value to you. What can we do to help you guys? And obviously it comes right back. Let's talk a little bit about some fear as you're growing a business. I think you got a lot of people in the market too that are fearful right now with what's being talked about. Any fearful moments in your life right now that have made you create more sources of income for yourself, or was the big push? It was, I know, to help with your tax bill. Any other fearful moments that you can handle, or share how you handle those fearful moments as you're building a business?
Yeah, I mean, I think multiple streams of income is always good, and I've always had multiple streams of income. So even right now, I have my medical clinics that I still own that are cash flowing still very nicely today. I also have a couple other companies that I have that actually produce an income for me. I also, right now, between my wife and I, we have 75 different LP positions with about 18 different operators around the country, primarily multifamily, but also self-storage and a food hall out of Nashville, Tennessee, and several different projects around the country. And we also have some angel investments as well. The angel investments don't usually provide income or ever, but they eventually will pay out. But we've always had multiple opportunities and ways for us to be able to generate an income. And that's one of the things I always and stress to any business owner is to never rely on just one income. You want to always have multiple streams of income coming in, and that's what we have today. And I think that's one of the things that makes me feel comfortable. It's also one of the things that allows the lenders to be able to be comfortable lending to us, because they know we're not just relying upon one income. We have multiple streams of income coming in. And I think that's also another reason why investors like investing with us, is because we are not just making decisions to pivot in this business, but we've grown multiple businesses in the past, and we know how to make changes and watch KPIs and check those measures and make pivots and changes as necessary based on the current condition that's happening in the market.
Yeah, gotcha. So when you guys are building your business, I'm sure there's been some challenges you've come across where you're like, man, this has been something that's added more challenge. What's your general philosophy on how to get through and handle the stuff that's coming up that's potentially blocking you from growth?
Yeah, I think a lot of times challenges that come into the business can block you from growth, because you kind of get caught up in like the I call it the kind of oh crap mode, where you kind of put the tail between your legs and try to hunker down and have fear and worry on that particular thing. And one of the things that I've always tried to do is just to make sure that even when adversity comes about, you can't stop focusing on growing the company as well as maintaining what you already have built up to that point. And so when adversity comes, we have to continue to still focus on growing the company and having those initiatives in place. And I had an incident that happened, a malpractice claim that happened at one of our medical clinics. And, we were in that time, the process of growing. We only had 2 clinics at the time. We already had plans to grow and double the size to 4 clinics. And, we could have put our tail between our legs and just kind of held on tight to kind of see what's going to happen with that particular, lawsuit or whatever with the medical clinics, but we didn't. We just continued to maintain, and we continued to grow even through that adversity. And, the ability for us to continue to grow and maintain that trajectory allowed us to get through those lawsuits even better. And on the other end of it, we were stronger and even better than when we were when we first got those lawsuits. And so, those types of experiences in my former businesses, or I say former businesses, like those former incidences in my current businesses that I have today, has allowed us to be able to continue to stay strong, even though there is adversity in the current business. I think the biggest adversity that we're having right now is there's a change in some of the investor sentiment, right? I don't think that this year is going to be a higher growth year, if you will, from the years past, because of some of the sentiment from investors. I think investors are checking their investments and kind of seeing where they want to put them. I know multifamily has been a little bit harder to raise money for this year. Same thing with self-storage and hotels. The one that has done really well for us is our Express Car Wash brand, because it does have higher cash flows. And even we were just looking at the numbers this past Saturday. This past Saturday, we washed more cars than we've ever in our entire portfolio. And right now, we got 22 locations across the Southeast, primarily from Maryland down to Florida, and they continue to grow and continue to cash flow nicely. And they haven't really seen any major issues. I think a lot of it has to do with the monthly recurring revenue that is inside of those express car washes. And it has been very attractive to a lot of investors that have been a little bit concerned and worried in the multifamily space of, hey, let's diversify our investments a little bit, maybe put some money into the express car wash space. And it's different and unique because a lot of people don't understand what that business model is, but it's also a real estate place. We're buying the underlying land and the building, but also the business itself.
Yeah, what's your guys' projection as your company of where we see interest rates go and trend over the next, let's call it 12 to 24 months?
Yeah, I think we're almost to the peak of where we're going to see interest rates right now. I think there's definitely, with some of the recent market numbers and the data that's coming out, that there's going to be another probably 25 to 50 on the low end, maybe upwards of 75 to 100 basis increase over the next couple of meetings from the Fed. But I think in Q3 we're going to start seeing a leveling off. And then potentially in the latter half of Q4 and into Q1 of 2024, we may start seeing some quarter to half a point reductions, depending on the economic state of the inflationary numbers, as well as the CPI index, and several other kind of factors that are being determined as to whether or not the Fed is going to kind of stay at the current rates, or maybe start trying to pivot to a downward trend in those interest rate hikes.
Yeah, with where the economy is today, I think you got a lot of investors who their sentiment, like you said, is sit on the sidelines and wait. What's your thoughts on that? Do you wait and think there's going to be a bloodbath of deals coming to the market, or what do you think we see come late Q3, Q4 this year, and what does it look like as far as asset prices?
Yeah. I mean, I think anybody who tries to sell an asset this year is going to see a reduction in their price than what they were going to do last year this time. I mean, last year this time, when they just started doing the interest rate hikes, which is still, mind-boggling to a lot of people to realize how fast interest rates have increased. We do have questions that come in from our investors about, are we upside down on a property? And it's like, well, yeah, we're upside down on a few properties if we were forced to sell today, but we never plan to sell in a downward economy. It's one of the reasons why, even though we do a 5-year hold on our assets, we don't have in our documents that we are forced to sell in 5 years, because if we are in a downward trend of the economy, we want to be able to hold on to that asset until we can get onto the other end of any type of economic downturn. And you saw that back in 2008 as well. A lot of the 2008 financial crisis, asset prices plummeted, but they rebounded, and they rebounded more than they ever have. And I think we're going to see that over the next 2 to 3 years, where prices are going to stabilize a little bit, later part of this year and into 2024, and then they're going to start to increase again once interest rates start to come down a little bit as well. And so I think that's one of those things that we have to continue to look at is like when we are planning to exit a property, and what's going to happen with those values of the assets. But right now we're not being forced to sell, so I'm not worried about any of the assets that are in our portfolio right now. And I think that we're in a very strong position to hold on to them until the other end of this thing, and that's going to be really, really a good thing for us and our investors as we continue to maintain the rent growth and continue to maintain the communities that we have.
Gotcha. Great. When with inflation obviously being the highest we've seen in a long time, it's eating away at a lot of people's savings, and we got the stock market coming down, and it's preventing millions of people's ability to retire. What would you say are some of the best alternatives for folks that maybe were thinking they were going to retire and now it's being pushed off? Do you have any advice of what they could do or start to do to bring that retirement back into their near future?
Yeah, I think a lot of people are realizing that relying on the stock market for their retirement is probably not the best thing to do. And it's my opinion that more and more people should start to move their investments over to more real estate backed type assets that produce a very high cash flow, but also produce, I don't want to say really high, I would say a more, consistent cash flow, whether it be a low to moderate cash flow, but then have the ability to, increase their net worth over time by putting them into these types of investments. I think, one of the things that everybody always says is from back in 2008, how their portfolio dropped by, 60, 70, 80%, and their money's gone, right? And technically their money's not necessarily gone. It's only gone if you were forced to sell at that time, right? But those people who held on to those portfolios were doing really well before the last, economic downturn that we're seeing in the stock market. And I think, if as people don't freak out and try to just like force sale everything out of their portfolio now, that we will see a rebounding in the stock market. I think that will, help people over the next probably 1 to 2 to 3 years rebound their portfolios. But I think over that 1 to 3 year period of time, they should start to shift more aggressively into more cash flow producing real estate assets that will allow them to have that consistency in cash flows in retirement, which will allow them to retire sooner. But even those people who might have to work a few more years, I think that's what you should do. If you have to work a few more years to get that income back up, get that savings back up, then that's probably a wise thing to be able to do. But at the same time, moving some of those into cash flow producing real estate that provide a lot of benefits from a tax perspective as well.
Yeah. Do you think we're going to see unemployment come down based on what we've gone through with COVID and the demand we have for employment right now in the market? Do you think the Fed will be able to create what they're trying to, which is a weaker economy, or how does this end, do you think, or how does it play out over the next 12 months?
Yeah, I mean, I think unemployment right now is at some all-time lows, and I think that we're going to, as they continue to pressure the market and increase the interest rates, and it's going to hopefully, as we've already seen, going to help to stay or reduce inflation, if you will, to a more reasonable number, which their number, of course, is 2%, getting close to that 2% number. I think that it's the reason why it's taking as long as it has is because it has been high for such a long period of time that we need to, bring that back down to a more realistic number. But I think that is going to also cause, which we're already seeing, layoffs happening across the board. And I think the reason why we haven't seen some of those layoffs really affect some of the job numbers right now and unemployment is that they have had a lot of, I'm forgetting the word here, but they're having a lot of what's the word there for I'm forgetting it. Severance. A lot of employers are giving people severances, like 4, 6, 9 months of severance. So those people aren't necessarily going to be appearing on those job numbers. But so I think there's a little bit of a delay in those numbers. And so I think that, again, over the next probably 3 to 6 months, we're going to start seeing the unemployment in the numbers increase. But I do also think that there's been a lot of people that have lost their jobs that have decided that they wanted to start their own business and do their own thing, which I think is a good thing for the overall economy. But those numbers are not reflected in the unemployment numbers either. And so I think that they're pressuring by increasing the interest rates and trying to reduce inflation. It's going to get, the debt side of things is going to cost them more money. And I think it's also costing businesses more money. And so they're going to start to look at their numbers and start to, have some pretty high layoffs, which is going to affect the unemployment numbers.
Gotcha. Yeah, I love it. So any major lessons that you'd share in your years here of real estate investing that have been maybe some of your kind of laws of investing or criteria of investing of yes or no when you look at a deal? Let's say an LP is looking at a deal, or a limited partner is trying to figure out, am I going to invest in this deal or not? What are some of the things that you would say watch out for or be aware of to say yes or no?
Yeah. So, I actually, with my wife and I invested in, just over 75 different LP investments across those 18 operators. We actually, sat down and created a list of 7 red flags of investing in real estate. And I'm not going to go over all 7 of them. If you want to kind of go to our website to find that, you can do that. That's just the passiveinvesting.com site. There's a knowledge center which has that on there. You can just search for red flags and find that article. But one of the things that I feel like is very, very important, as what I would call a red flag, is couple of things. So number one, you always want to make sure that there's somebody who is the main operator that has some form of background and successful background and being able to manage businesses. They don't necessarily have to have been an owner in a business, but I think they have to have some sort of success in managing a business. And that's key, because at that and in times like this, you want to have somebody that doesn't just put their crawl up in the fetal position and go in the corner and suck their thumb and put their tail between their legs. You want them to be able to go out a strong and trying to actually right the ship, if you will, and correct things, and making sure that the decisions are being made instead of getting into this kind of analysis paralysis, if you will. And so I think that's very, very important from a strategic investment perspective. So that's one of my red flags that my wife and I have, is that if the operator doesn't have some form of successful background in business, we don't want to invest with them. One of the other ones would be that same operator. Those operators need to be full-time in the business. I think a part-time operator who tries to do it in nights and weekends is a no-go for us, because I've worked very hard for my money. I know our investors have worked very hard for their money, and I want to make sure that I have full-time eyes on my money. And so there's a lot of people that try to get into this space and try to do it as a nights and weekends type thing. And I've seen too many investors that have started to lose money, especially right now with the current economic conditions that we're in, where they went out and they raised money to acquire one or two or three assets, and then they stopped and they got over their head, and they're still trying to maintain their 40, 50, 60 hour a week corporate job, and now also trying to manage these properties that really need full-time attention, and they're just not being able to do it very, very successfully. So that's another one of our kind of red flags. And the last one I'll share, of the seven. As a matter of fact, I have 8 now. I'm getting ready to add another one to it, which I won't cover that one just here on the podcast. But there's another one that I've added recently due to the market conditions. But I also want to make sure that there's preferred returns with the investments that we invest in. So I feel like it's a good alignment of interest with the operator and the investors. And so every asset that we've ever put together, we've always had preferred returns, usually between about 7 to 10% preferred returns on the investments that we have. The car washes have a little bit higher. They're usually closer to 10%. The multifamily is usually around 7%. Sometimes we've done them at 9%, depending on if it's a preferred equity position or not. But I think that the preferred returns are very important, and what I would call, not what I call, but what is called a true preferred return, where there is no GP catch up on the other end. So it's on all of our assets, 100% of the cash flows goes to the investors up to that preferred return, and then the equity splits past that. Some operators do it where they have a preferred return, but then they have a GP catch up, where you might get 100% of the cash flows up to 7%, but then we're going to go back to the very beginning as if we were splitting it 70-30 or 80-20 or however it was, whatever those splits are from the very beginning. And so I feel like with the current conditions in the market, it's a very rich thing to do for the operator to do that. And I don't really think it aligns very well with the interest of the investors. And so those are just a few things that I would say are key things that we look for when we're trying to do our investments, and how we actually present them to our investors as well.
Gotcha. Good. I love it. One question on the preferred return, just for clarity for our listeners, and even for myself, if you're investing in a deal with preferred return, and let's just say you have a bridge model and you're not able to give the cash flow, the gap between the rate cap hasn't kicked in, and you can't send the preferred returns, what happens and how do you cure that as time goes on?
Yeah, so we actually do what's called a cumulative preferred return. So it's not compounding, but it is cumulative. So if in any given period, so like any given year that we're in the asset, and let's just say we were giving out a 10% preferred return, if we could only give out 5% during that period, then that 5%, they'll still get made whole on that when we sell the asset or when cash flows increase. And so like the next year, instead of the preferred return being 10%, it would actually be 15%, right? And so we still, as the operator, don't get any of those splits until we can make sure that the investors are whole on their preferred return.
Gotcha. Understood. Okay, great. Thank you. Let's say any major lessons, so that's a good LP kind of watch. Any general partner lessons for the folks that are putting together deals, biggest things that you've learned in the last 3-4 years that are worth mentioning to make you a better operator?
Yeah, I would say 100% always get a rate cap if you're doing bridge loans, right? I think that's one of the things that definitely had saved us. And yes, they can be a little bit expensive, but when we were buying them, they were pretty cheap. I mean, we're buying, rate caps for, 30, 40, $50,000. And, now you're lucky to get one for less than seven figures. Because they can get pretty expensive. So when you're dealing with bridge loans and things like that, always get those rate caps. I know a couple of our investors have reached out to us saying, hey, I invested with this other group. They didn't get a rate cap. What can I do? And I'm like, there's not much you can do. They're doing capital calls now, trying to save the deal and keep it from the bank and stuff like that. And it's gonna be a little bit more challenging for them to be able to get their investment out of that type of a situation.
Yeah, definitely. Good call there. You talked about pivoting in business. How have you known when it was time to pivot? And it sounds like you've got a few different asset classes you're in. What made you start looking in different asset classes and when?
Yeah, so back in the early part of 2021 is actually when we started to pivot into some other alternative assets outside of multifamily. And the main reason was because our investors started asking us about other alternative assets. And, we kind of already set ourselves up from the very beginning, knowing that we would likely move into some of these other alternative asset classes, because it's one of the reasons why we called the company passiveinvesting.com and not multifamilypassiveinvesting.com, because we didn't want to pigeonhole ourselves into just one asset class. But one of the things that I learned in my, business career is that we can't just take a core team that's focusing on multifamily and say, okay, guys, now that you're doing this multifamily stuff, now you want you to also start buying self-storage and car wash and hotels. And we did not want to distract each one of our teams from that. And so we actually have a different team that acquires the multifamily, and then that's all they do is multifamily. We have a different team that does self-storage and express car washes. And so we have these different silos that help keep them separate, and they're focused on that particular investment so that we do not water down what we are trying to accomplish with our investors. Because at the end of the day, we're still responsible for all the investments that our investors have entrusted with us. And so being able to have KPIs and measures in place to be able to know when we need to pivot and make those decisions is very, very important. And I'm a big believer in that if you can't measure it, you can't manage it. And so we have data and analytics that are happening every single day that are going to come across my desk as well as the rest of our team that allow us to know when we need to pivot. And I think, sometimes when we make decisions, we make them too late, meaning that instead of watching these numbers on a daily basis, we look at them on a quarterly basis or a biannual basis or even a monthly basis. And by that time, it's too late. You're now in a retrospective analysis perspective where you can't make decisions fast enough, right? And so for us, we want to make sure that we're monitoring those stats and that data on a daily basis so we can make those pivots and those changes sooner rather than later.
Great. What would be, if kind of leaving our listeners with some books that have changed your perspective or podcasts, what kind of would be some of the bigger life-changing mental mindset books you've read that have helped you the most with your entrepreneur business life?
Yeah, I'm going to mention a book that's not necessarily a business book, but I would call it my all-time favorite business book, even though it's not a business book. It's actually by an author by the name of Dr. Robert Cialdini. He wrote a book called Influence, The Art of Persuasion. And I read it at least once, sometimes twice a year, and it always gives me great ideas. But it's actually a book that talks about the social psychology of people and how they make decisions and how you can impact some of those decisions. And, one of them is the concept I mentioned early on about the rule of reciprocity, right? And so that's one of the concepts from his book and some of the research that he has done. And so I always enjoy listening to him and anytime of the time he comes to speak. And matter of fact, we have an event coming up in June of this year in Charlotte, North Carolina, and we've invited him to come and speak. And so I'm looking forward to being able to spend some time with him and maybe even sharing a meal and having him train some of our team members privately as well as being able to share the stage with him.
Awesome. Very good, Dan. Well, if listeners wanted to get a hold of you, what's the best way for them to reach out and connect?
Yeah, there's two ways. So first is going to passiveinvesting.com and then doing some research there. If you want to join us on some of our future offerings, there's a way to do that on there at the big blue button on the top right-hand corner. It says join the Passive Investor Club. If you want to just connect with me further and follow some of the content that we have, you can go to our website. You can go to the website linkwithdan.com. That brings you straight over to my LinkedIn profile. So you just go to linkwithdan.com and go straight to my LinkedIn profile. You can connect with me there and follow us further.
Awesome. Thank you, Dan, for coming on. And thanks for tuning in to today's episode. If you're ready to take action and start building wealth through multifamily real estate, we encourage you to reach out to us. Click the link below right now to take action and just start changing your financial future. And we're going to see you guys in the next episode. Thanks so much.